All right, so welcome everyone to our session here, Unicorns and Juggernauts. Some of you may have been wondering about the title a little bit. And simply, unicorns, as most everyone knows, are startups that have achieved a billion-dollar plus valuation. And Juggernauts are the parallel in the enterprise. So business lines, product lines that have grown from nothing to billion-dollar plus. So Chris and I are going to talk to you guys a little bit about some of our experiences with unicorns and juggernauts and how they are really symbiotic in helping each other achieve those status. So,
Perfect.
all right. In the startup world, we have a lot of statistics that end up indicating that it's a hard thing to become a unicorn, right? 90% of startups that are new fail. And you can see the statistics. It goes on and on. 10% of new businesses don't survive the first year. 34% of small businesses that fail because they don't have the right product market fit. And 30% of startups that are venture-backed end up failing. Venture-backed startups end up producing the most unicorns at the end of the day. And it's always kind of viewed that these venture firms have the best track record. But in reality, 30% failure rate of venture-backed startups is pretty significant. So I think we have some equipment problem here with Chris. So I'll keep going on. In the enterprise world, like we mentioned before, there is a parallel in the enterprise world. If you think about strategic initiatives that go on in an enterprise trying to build a billion-dollar business line or product line, going through a change initiative. You can see the rates up here. 90% of organizations fail to execute their strategies. And 70% of all the change initiatives that go on fail. 70 to 90% of all corporate M&A ends up in failure. And failure there means that they fail to produce value. And they fail to produce value usually because the integration or it's one of two things. The strategy was incorrect, and you can see the failure rate on strategies up above, or the integration was not done in the manner it was supposed to be done. And 30% of failed integrations are really attributed to cultural differences. So the company wasn't a fit one way or another. And these two sets of statistics, aren't what we're going to talk to you about. It's just sets up that it's a very tough environment out there if you're going to when you get to the point of becoming a unicorn or a juggernaut, you've overcome these odds and these statistics. But usually that doesn't happen by accident. And that's what we're going to talk to you a little bit about. Before I hand it over to Chris, who's gonna speak a little bit more around that journey to becoming a juggernaut or a unicorn, I'll put up a point here that is probably pretty obvious, but your odds of success really depends on the ecosystem. So the ecosystem exerts a disproportionate amount of influence on success or failure. And we're gonna go through some presentation charts. We're gonna talk a little bit. We're gonna share some stories, but we do want to make this interactive at the end of the day. So feel free when we're going through the examples to throw up questions, and I think we're gonna have a microphone going around. So please feel free as we go.
Mm-hmm. Awesome. Thank you, Chair. I think one of the other things that when Tushar was going through those slides, it was interesting that it was about a 90% failure rate, both for enterprise and for the startups. And then it was about 30% on the bottom for both of them as well, right? That there are a lot of parallels in the numbers. And if you look at it, that they're really trying to move up these pyramids, right? And that there's the bottom is the failed startups, next is a viable, but then you have that small number that become unicorns. But it's the same thing on the enterprise side, that you have a ton of things fail, you have some that become viable, and you have a very small number of juggernauts. The ratios between these might be a little bit different, but it's really, there's really a lot of similarity. And one of the things that we want to talk about is people tend to look at these as two very different things because they're very different sized organizations. They've been around for very different amounts of time, but that really there are a lot of things that there's synergy between these that people miss and patterns that people miss that actually allow you to be more successful on each of those sides by working together in ways that aren't common and aren't typical. So that's really what we're going to be talking about today, and that success really becomes possible by creating the right types of bridges, and that's really what happens, why this doesn't tend to work out. First of all, if you look at startups, the vast majority of them never even think that they could go through and figure out a way to work with a strategic partner who's an enterprise. But even the ones that realize they could have no idea how to actually do it for the majority of them. And then that smaller number that realize they can do it, actually make an attempt and make the connection, the problem is that they don't take the time to understand how to build all these bridges and actually have no awareness of what all these bridges are to actually make that work out in a way that's amazingly beneficial to the enterprise and also amazingly beneficial to the startup. And so we'll go through a few examples of how that's worked and why that's worked so that you have an understanding of what this is. But these are just a few of the pieces, so things like go-to-market reach, integration, establishing credibility, finding the real product synergies, and then how do you make that operations piece work out so it's seamless and flawless between them. So we'll talk more about them as actual examples because I think instead of just hearing ideas, like it's a lot better to hear what actually worked in the real world and how it worked. So we'll actually go through that. And we're going to start with 3 different examples. And again, as Tushar said, if you have questions, things you want to talk about, we do have mics so we can make sure that you can ask questions throughout. The first one example is large enterprise, and it's called the Accidental Unicorn Factory. So we'll talk about how that worked and what drove that. The second one, turning operational data into value, is looking at, there's often hidden gems within organizations that people don't recognize, and how do you start to unearth those so you see that these things would actually be of strategic value to one of your partners. And then the third is the alpha generating robots. So the first 2 are things that have already been completed, and we can talk about exactly how it ended up. And the third one is actually one that's in process, so you can kind of understand how it works as it's in process. So I'll turn it over to Tushar to talk about the Accidental Unicorn Factory.
Right. So catchy title, right? Accidental Unicorn Factory. Let me give you some context into this example. Large multinational technology and services company with an outsourced technology solution for about 1,200 customers. This business was one of their business lines. It was a cash cow type of business. Revenues flat-ish to maybe slightly down over time. Very profitable business, great customer base, but they were having a lot of customer sat issues. The customers wanted innovation, couldn't seem to get innovation from the provider, just the way the solution was locked and so forth. So a lot of these customers would set up shop in Silicon Valley. They'd hang a shingle in Silicon Valley and they'd go speed date VC-backed technology startups looking for the next innovation that they could use or integrate into what they do. And what we did essentially was we set up a bit of a different type of incubator and accelerator, where the objective was not to invest in potential high-value startups, but really to look for innovation that the customers were seeking and integrate it into that large technology provider's solution. The outcome, and we'll get into the things that enable those outcomes, those bridges that Chris talked about. The outcome was pretty unique. At the end of the day, there was a lot of standard things that were done, like just speed dating of startups, filtering the technology for use cases and things like that. At the end of the day, there was a series of companies that were integrated into the solution of the large technology provider that ended up giving their end customers the innovation they were looking for in a really de-risked way. Pre-integrated, pre-vetted, able to operate end-to-end within their larger technology solutions, et cetera. And for that business, it ended up taking that cash cow of business and actually improving the customer retention, driving growth, and maintaining that profitability. So it really revitalized the cash cow. For the startups, it was quite beneficial for the startups. Those that ended up with a critical place in that company's solution went from, in some cases, went from single-digit customer counts to 700, in one case to 1,000 customers overnight. So by nature of being into that solution, these customer counts went through the roof. They had a revenue model for enterprise customers, and they ended up, some of them, I can't share the names, but some of them are public companies now traded on the NASDAQ with multi-billion-dollar valuations. 4 of them ended up getting over $1 billion valuations at the end of the day. So they became unicorns, and hence the accidental unicorn factory. But the key to success here, a lot of large companies go hang up a shingle in Silicon Valley and look for the startups that are either going to be synergistic to their solution, their business, their company, their customers. But the thing here that was a little different was the bridges that we created. First was around integration. We set up and funded a integration lab with dedicated engineers, and the monetary investment in this was for very practical things. Projects, fly engineers from point A to point B, get units of one stood up in customer environments, right? These types of things were critical, because it's where, when we looked at the failure rates earlier, it's where most of the failure occurs in an M&A condition. So integration was key, and we only were able, it may sound simple, but we were only able to focus on that because it was not set up as an investment vehicle. It was really truly set up as a technology and integration vehicle. So that's one. Second, the go-to-market reach. A lot of the startups had very good technology, very good promising technology, but they were all geared at enterprise. They were selling to the enterprise, and they were starting with building a very traditional-looking enterprise sales team to carry their product to market. Looking to team with enterprises, looking to team with their customers to develop out their product, make sure it was integrated well. By coming into this type of model where the integration and the customer was handled by the larger company, they were able to truly just focus on their technology in order to get them that market reach overnight. And like I said before, many of these companies went from single-digit customer counts to 700 customers overnight. In one case, 1,000 plus customers. So it was a very different go-to-market reach model for those startups. And then last is credibility. Usually in cases like this, the small startups get lent the credibility of the larger enterprise. this was a little bit of a reverse case where the large enterprise knew they were seeking the credibility of the startups because it was the only way they would be viewed as innovative in their customers' eyes. So that's the accidental unicorn factory at the end of the day. Any questions? Or? So that's a great example of a large multinational revitalizing their cash cow and early startups making it to unicorn status with, a very directed path. The next one we have for you is a little different, but it also illustrates this notion that Chris was talking about the synergies that a large company and a small company can have together that they pull each other up, right? The last example I gave you, neither the startups nor the large enterprise could have done that model on their own. Oop. Sorry. All right. This next one is from the standpoint of a Series A, Series B venture-backed company. It is a treasury and liquidity management platform for hedge funds. It has about 200 hedge fund customers, and most of the top hedge funds in the world as customers. And one of the things it does is, one of the things required for this platform to run is they consume all the data, all the trade flow data from the hedge funds. So company's got a great customer base, but it's still pretty small. I'd still put it in the startup category. Valuation, in the $150, $200 million range. And what the company did when they were raising a round of capital is they got a strategic investor. That investor happened to be a large public company that is probably number one or number two in selling market data. And one of their customer categories is hedge funds. And they sell market data to hedge funds. And they do a pretty good job. They have a large sales force that covers the globe, what you'd expect out of a large enterprise. That investor was able to kind of see the value that was kind of what I'll call hidden inside of that Series A company. And what they did was they identified, if you have all the trade flow data of hedge funds, there's some very valuable stuff in there that doesn't exist elsewhere. And one of these things was short volume data. Most of the shorts that are done in the market are done by hedge funds. 90% of the short volume is done by hedge funds. So essentially, that large investor helped this small company to create a new product line, aggregating and anonymizing all the short volume data. It wasn't a business that this company was familiar with or suited for. It takes a very different sales organization and go-to-market organization. And the large company lent it a lot of, gave it the blueprint on how to create a data product, how to set up operations around the data product, lent resources in creating that data product, and then carried that data product to market. And what it did for that large company is it filled a critical gap in their product set, which enabled them to improve their win rates and their revenues. And for the small company, obviously, it created a whole new business line. And that business line created a stream of ARR, annual recurring revenue, and valuation that almost tripled the valuation of that startup and that company. And it was merely taking advantage of the data they already had going through it, but they never would have done that without the expertise of that large investor who was in that market and in that product arena. So the bridges here that were really kind of critical was around product synergy, and this goes to leveraging the hidden gems in each of the large organization that the strategic investor had, and also that the Series A startup had. The second one is around go-to-market reach. Even if the startup was able to aggregate and create this data product, it didn't know how to sell data product, didn't have expertise in their sales force around selling data, contractual structures and alike. So the go-to-market reach was really the thing that was out there and existing that enabled the operation to happen in a bilateral way. And last was operations. When you run a data business, data is produced in some real-time capacity. It's packaged, it's run, it's cleansed, it's delivered. It entails a good degree of operations. And what the Series A company didn't have was the ability to set up that type of operation. So it was able to take a blueprint right from the large partner and investor, set up that operation, and on the run of that operation, was able to use resources from the large investor, actually lent operational resources to fill gaps in talent as the business was running. So really synergistic operations at the end of the day, where one partner is lending because they had an investor relationship, but they were lending resources to make sure the data operation and everything was going smooth. So that's a little bit about that one. Before we get into the next one, AI alpha generating robots. Chris, you want to talk about this one?
Sure.
I'll just kind of set up. So my background, I spent many years at IBM. I was the chief operating officer for their global technology services business. And in that capacity, we implemented a lot of large language models and predictive AI models. This company, this small AI startup company, is actually here today. The CEO was just doing a talk on the other stage. But based on my experience in implementing predictive AI, they have a very, very profound technology that they've made for the capital markets and for trading, right? Synthetic portfolio managers. And they've been around for about 5 years. Their product is mature, it's tested. One of these AI synthetic portfolio managers actually ran an ETF on the New York Stock Exchange. Just a fantastic product. The company is full of PhDs and physicists and engineers. Really can't say enough good things about this company, but it lacks market reach. It lacks the ability to be known. And Chris, you want to talk a little bit about it?
Sure. So I think one of the things that's interesting, the first thing up here, the category forge, is really about, I think a lot of times people look at, we're competing in this very crowded market, and how do we stand out in this market? And that's actually the wrong question, right? Like you had the Glenn Ross quote that coffee's for closers, or Boss Baby had the take on that, which was cookies are for closers, right? But that's actually the wrong philosophy, right? You don't want to go out and be really good at sales. And the reason is, if you're really good at sales, you're just trying to constantly pound down the doors and push and push and push and push. But what you really want to do, and where you get a lot of success, is to stop that bloody battle for market share and figure out, how do I switch this around and create a distinction and create pull, so that my customers are starting to come to me because they realize I'm not just like the other things, but maybe a little better in these ways. I'm a fundamentally different thing. I'm in a category of my own, and this is what we do, and this is why you want to come and work with us, right? And that once that's clear, you end up with people spreading that message to other people that you have never talked to, and start getting inbound calls because they're like, wait, I heard you do this thing, right? And so as Tushar said, they were talking about what they did with AI and how they developed this great technology that was really good in the capital markets. But the thing that they didn't really talk about, and the thing that really sets them apart, is what they've actually created is an AI portfolio manager, right? Not just a trading system or something that does little pieces of things, but actually does what a true portfolio manager would be doing in a hedge fund or somewhere else, right? So they've actually created something that's a lot more comprehensive and different in the marketplace that's not really out there. And so that's that first piece, is how do you forge that category that people recognize, oh, wait a minute, this is different. And they may say yes or they may say no, but they know what they're saying yes or no to, and they can describe it easily to someone else about what that is. The second one is the strategic unlock, and that's really looking at, instead of going in and selling a product that solves a problem for a customer or fills a need for a customer or fills a space in one of their current buckets, how do you actually understand what the client is trying to do strategically? So from an executive perspective, what are the things that are going to help the company move into the future that they want? And then look at how do you sell into that vision of the company and where they want to go, and how does this fit into that forward future that the organization wants to go. And if you're doing that, you can end up having conversations with the C-suite as opposed to having conversations with people in the organization that are just making decisions based on the criteria that was set for them, right? That the C-suite can actually go through and shift how they're making those decisions and change those priorities. And I can walk through a couple examples of that as well. And for here, there are a number of things that are happening in the marketplace that this solves something different for, right? So there are a number of large asset allocators, so think of pension funds or sovereigns that have started bringing things into house now, right? So they're starting to bring their private equity business into house and not send it out to other private equity shops. They're starting to bring other things in. And what this allows them to do is to start bringing in the hedge fund, being able to do the hedge fund in-house as opposed to having to send that out, right? So it's giving them control over their destiny, which they've been doing in these other areas. This is another way for them to start bringing that control in-house and being able to control their destiny. But also, at the same time, they're trying to understand, what do we do with AI and how do we really use this effectively? And now they have a partner that's on the bleeding edge of AI that can help them understand what actually works and why do those things work, and how do you apply this in other areas of your organization to be able to get where you want to go, right? So having that strategic conversation totally changes the discussion, because what happens when you're at the CXO level is they can actually create budget and they can create new things of where you're going. You're not just trying to fit into what they gave you already, right? What was predetermined. And then the committed co-creation is really that you start activating people in the other organization to start being involved in your adventure, right? They're not just funding you or helping you with something, but how do you engage them in your adventure so that they start to play on making you successful, and you're in there playing to help them be successful. So it's really how do you generate agency and responsibility in the organizations and change those things. So, and I can give you a couple examples from the past, but just to kind of talk through the highlights and what we wanted to make sure that you went away with. The first one is stop pushing for sales and kind of rethinking that bloody battle for market share. That going out and knocking on a ton of doors really leaves you with bloody knuckles and worn out shoes, right? So, but that real market shaping power comes from flipping how you're doing things to figure out how to create pull. And I'll give one example. We worked with a company that in a totally commoditized business where you would never think that there was a way to actually create a category or make things different. And they're actually in steel fabrication, which is pretty terrible business. The margins are low single digits, and it's basically based on who ends up with the lowest price in the bid, and you're spending a lot of time, energy, and money just putting the bids together. So there's a lot of engineering work just to put together the bids for that structure you're building to put into a bridge or put into a skyscraper. But what we found as we were talking with them is that kind of hidden gem within the organization was the thing that they really liked doing. The people on the floor, the welders and fabricators, actually really loved doing emergency work. And because it was interesting and it wasn't just kind of the rote thing. And so as we were talking to them, they're like, well, we get it every once in a while, but how do we get this on a regular basis? It seems like it's probably better business, and we find it more interesting. And other shops don't really like doing it. And so I went back and I talked to the owner, and he's like, oh yeah, that business is amazing. He said, we end up with 50% margins, 100, 200% margins on that business, and they're happy to pay it because their bridge is held up, right? Or their skyscraper is held up. Like, this is critical for them. And I said, well, you spend all this time and money going out to do these RFPs. What are you doing to get these? He said, oh, well, we just wait until they call us. Like, I don't know how you would get this business. And so we set up a way for them to start reaching out. But the funny thing was that once you got this going, they started getting all of these inbound calls from people saying, hey, I talked to Dominic over at W&W Steel, and he said you might be able to help me with this. We'd never reached out to this person, right? But that because it was easy for Dominic to say, hey, if you need something right away and you have an emergency, you got to call these people, right? So getting that message that's super easy for someone else to communicate and that they understand the category, they end up their revenues went up by about 400% in 18 months. But that wasn't actually the interesting part. The interesting part was that their profitability went from about 3% to over 50% in that same amount of time, right? And so, like, rethinking how you're going in totally reshapes your trajectory. And I think that's one of the most important points we want to leave you with. The other thing is that unicorn and juggernaut probabilities completely change when they work together in the right way. And they take the time to build those bridges so that it actually works well. And so it's really about pulling each other up those pyramids as opposed to just trying to go it alone. Oops. And that as you do that, how do you end up with that actual genuine symbiosis between the two? And that the real power in there is the integration. And so
I'll just add on that on the integration. It's a much deeper integration than most companies can ever achieve through M&A. Mm-hmm. Right? Through a bidirectional business type of arrangement, you can get much better integration if you set it up correctly.
Mm-hmm. But it has to be thoughtful, right? Tushar?
Exactly.
Like you took a lot of time building that out and figuring out what are all the barriers that most people never even consider, right? As you were going through and doing that, which is why it worked.
Right.
Yeah.
Exactly.
And so really it's about those bridges that if you do those well, it's a lot easier for the startups and the enterprises to get to exactly where they want to go, but do it together, right? That's a much easier thing to have happen. It takes a lot more work up front in order to figure out what are all those pieces and how do we put them together. But if you do that hard work up front, it's easier for forever, right? And it's those types of things that I always find worth doing, right? That it may be more work up front, but it's a lot easier for forever. And so the thought we want to leave you with is that they're not really kind of two independent things. When you integrate them together, and the unicorns can kind of be the heart of those juggernauts that are out there and have the market reach, that the unicorns and juggernauts will occur most predictably and consistently when they figure out how to build that right symbiotic relationship. So if you're an enterprise or an upstart determined to build bridges to slingshot you forward, we're interested in two things. Like if you're interested in understanding this more or how to apply this, certainly love to talk to you about it. Also, we're always interested in stories that people have about how this has worked well in their experience and where they've done it. So they're the 2 email addresses here, and we would love to hear more about either your questions or what you found worked for you if anyone has stories. So does anyone, can we get a microphone?
Testing. Well, first off, I just want to say I think the discussion was completely spot on. I mean, I could almost feel my life being lived up there in some of those conversations. But I thought it might be useful just to give you kind of a real life, real time experience. So we developed a SaaS B2B product in the home services market to help companies manage their lead flow better through automation and aggregation. And so anyway, we felt this incredible pressure to start selling, so we really tried to sell too early. And as a result, we weren't very successful with that, but because the product wasn't that good. And so what I would say is make the product good, really, solve a big problem, obviously, but you really have to make that product exceptional. And you're better to spend your time doing that than to beat the street sometimes. I actually had to lay off the sales staff, lost, 150 grand or something in that process. And we circled back up for about a year just working on the product, okay? Fast forward, we ended up pursuing and getting or actually they almost pursued us, but we ended up getting a large strategic Fortune 500 company, $13 billion company, and we're bringing on 25,000 accounts at one time, only because the product became excellent. And so that's exactly right. I think we sometimes get it backwards. We sometimes have to realize that we have to take a minute, and it's hard. You have to have patient capital. You have to have people willing to let you do that, and then you can really do something special. But there's so much initial pressure to sell. You can really get ahead of your skis, and then all of a sudden the whole business is kind of out of whack, and you're really, it just doesn't work. So we were fortunate that we could turn it around, but that's exactly right.
Well, and I think finding that right partner, right? That it wasn't just any Fortune 500 company that would have been amazing for you to work, right? But how do you find that, like the other piece is making sure that you find that right partner and set things up correctly so that you end up with a result like you had?
Well, I think for us, we found that there was a big industry problem. So we knew the problem. We understood it really well. I think we had a good understanding of the product. We started working at some low-level people within that company, got to some area sales managers, and then kind of worked our way up, and then eventually worked our way up into the strategic thinkers in the company, and then was able to really, the funny side story to that was that they said, hey, we want to come down and see you guys, and they jumped on a corporate jet and brought about 10 people down. We had 2 people in a room, and I put everybody I could in a seat, and we had a good meeting. It worked out, but I think that it takes a tremendous amount of perseverance. But we would not have met the moment if we would not have had a great product.
Yep.
The product had to really be there at that time, and if we would not have made the strategic decision to go back to the product and really develop it better, we would have missed that opportunity. It never would have happened. So I really say product first. You really got to get it right, and then a lot of opportunities will open up.
Yeah, great example. I think in the Unicorn Factory example we did up here, a lot of that integration capability we set up was about, making sure the product was strong as much as it was about integration, right?
That's right. And it took, honestly, we kind of put all our efforts into this deal, and everything else went on the sideline, and it took about 9 months to do the technical aspects of it. But it's a game changer, and so I do think that there's a strong argument. It's very difficult to do a startup. It's extremely hard. I think the ecosystem approach and trying to get into the ecosystem, ideally become an essential part of it, is really important. But if you can put yourself in the position to operate within the ecosystem, you can leverage those large user bases and those other companies, and you can really accelerate the growth of your business, and that's a great way to do it.
Yep. So would love to hear more about your story. If you email us at Unicorn Juggernauts, we would at stories@unicornjuggernauts.com. Would love to get more of that, because it's one of the things that we talk about and we will also be publishing about. So that would be awesome.
Thanks, great talk.
Any other questions or comments or thoughts? We've got 3 minutes left. Over here. Oh. Look at you.
Sorry about that.
No.
Yeah, I thought it was interesting, and first, thanks you guys for talking us through all of this. It was interesting, and probably for a lot of folks who run startups, very non-intuitive when you talked about like, hey, don't just go for sales. You know what I mean? Because I think most startups out there right now are focused on scaling and hoping probably to get venture capital money, and then they're going to have to scale some more and all that kind of thing. So hearing that sort of like, probably, I imagine if there are some folks in this audience who run startups are probably like, well, I ain't going to do that part. I guess the key is probably to make sure that you're able to kind of enter into one of these accidental startup types of arrangements or scenarios, and hopefully if you find the right one. But I guess the question would be, if I'm a startup founder right now, how do I even begin that process? How do I find the right partner so that I don't have to worry about the sales force? They put together the sales team, and how do I, even vet out whether or not, I can imagine what some of the criteria would be in terms of better integration, but how do you even get to the dance?
Mm-hmm. Right. I think part of it is really looking at what is it that you're doing and what problem you're solving that would actually be helpful to one of those large enterprises, right? Like when Tushar was talking, that they were really looking at, we've got all these cash cows, but like, how do we keep them going, right? And how do we seem bleeding edge so that our customers aren't out like looking for all these startups by themselves, right? Or the other one where they were looking for, well, wait a minute, this is data that's not available anywhere, right? And we're in the data business, right? That you want to start to look at what are the things that you're doing that are actually distinct and unique, and that would offer an interesting accelerant to the larger businesses. So starting there, and it's not to say that you don't spend any time on sales and doing things, but that you don't want to ignore this, right? That this just is kind of a tidal wave that pulls you into the market. The other one is just like a constant drudgery to try to get a little bit of sales, and then as you get more and more sales, it just becomes steeper, right? Like it's more and more money, and it's more and more people, and it's more and more aggravation, right? So how do you do it in a way that maybe you build them in parallel, or if you've got enough runway, like you mentioned, right? And some more patient investors, that you can actually build it in a way that like it's a perfect fit for those strategies. But I think that the part that I'm really concerned about is a lot of startups don't even think about this, right? And so taking the time to make sure that you're actually looking at what all your options are and what all your opportunities are is really important. And want to get to your questions. Where mics are going to be cut off in 40 seconds, so if you can ask a question really quickly. Do you want to just yell?
Recently joined a cybersecurity startup, and a lot of times with partnerships, it usually is an awkward, am I selling your stuff or you're selling my stuff type of discussion. What's one piece of advice you have how to get more strategic on it?
Yeah, so it was that with partnerships, it's am I selling your stuff, are you selling my stuff? What's the piece of advice? I think that really looking at how you can help them solve more of a strategic problem, right? It's moving the discussion up a couple levels that gets them out of the kind of tactical and gets them starting to think about things in a more comprehensive way. And we're at time, so I want to thank all of you for coming to the session. And again, if you have any questions, happy to answer them for you, or email us, and we'd love to talk about it. Thanks, everyone.
Thanks.